if you don't have the time to go around and find great reinsurance managers or litigation managers or correlation managers or crypto arbitrage managers, et cetera, you can always do a cockroach portfolio, right? Because it's designed for dummies, and it will, I think, outperform pretty much all other balanced portfolios for the cost of an annual rebalance, which is not very much.
Thanks for joining us for part 2 of our interview with fund manager Dyland Grice. If you haven't yet watched part 1 of our discussion with Dylan, in which he explains why, despite his conviction that the current central bank intervention will ultimately end poorly, he remains reluctantly bullish that asset prices will move higher from here, then head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Dylan and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to support this channel by first liking this video and then clicking the red subscribe button below, as well as that little bell icon right next to it. Believe it or not, these tiny steps really do help us out. Okay, let's get started watching part 2 of our interview with Dyland Grice. Given all the challenges and the smoke and everything that we're talking about here, given how hot the central banks are cranking up the heat in the oven, how are you allocating capital right now in this environment? What does look good, or at least good enough to you right now?
Well, I should, I should kind of give you a little bit of a health warning, because we actually thought long and hard about my partner and I at Calderwood, about how we were going to answer the question that I think, we've been asking ourselves for years. And certainly when I was, kind of helping to run the family office, we were talking about, joining the family office, I think in 2013, and it was just a constant conversation until I left, a couple of years ago. And that problem we were trying to solve was this, how do we allocate in a zero yield world? Where do we get returns from? Right? How do we get returns which are not really jeopardized by a blow up in the bond market? Right? Because that's the kind of, I think we've had a kind of, a back and forth about inflation and a back and forth about the dangers of central banking and et cetera. But really, a much easier question to answer is, listen, do you want to be invested in government bonds right now? Right? Because if the answer is, well, not really, well, why not? Well, because they don't pay me anything, there's an awful lot of downside and not much upside. So that's not very attractive, right? If that's your answer, where do you go? Because ultimately, it's all about duration. The main asset classes are duration asset classes, whether they're government bonds or corporate bonds or equities in the public market, private equity, venture equity, pretty much everything that's done really well over the last 40 years. It's all been a duration trade, right? It's all done so well because duration yields have gone from 20% to 0%. So you ask yourself a question about what happens to those markets if yields go back up to 20%. And that's not a forecast, right? It's more like a stress test, right? It's not a forecast. So you say, look, they're at 0. They were at, in the past, they've been at 20%. They can go up to 20%. And again, that doesn't happen next year or the year after. But suppose we just had a bull market in interest rates. What happens if we enter a bear market? And by that, I mean, interest rates go to 5% in 5 years' time, and 10% in 10 years' time, and 20% in 20 years' time. That kind of grinding, increase in interest rates. Where does that leave us, right? Where does that leave your venture equity, right? That's tied up for 10 years. Where does it leave your private equity? Where does it leave your public equity? Where does it leave your bond markets? Where does it leave your fixed income? The answer is, I think it probably leaves it in the gutter, right? And so we said, well, how do we put together a portfolio that doesn't have any of this stuff in it? And that leads you away from equities, and it leads you away from fixed income, and it leads you away from private equity and venture and all of this kind of stuff. And the thing is, if you take that stuff out of the equation, it doesn't leave you with much, right? So our fund is, our kind of investment activities tend to focus on stuff that's frankly quite kind of niche and esoteric. And you know, we have there are lots of advantages with doing that. Firstly, it's just much more interesting. You meet more interesting people. It's much more entrepreneurial. Secondly, typically it's far less crowded, because people will look at something like, you know, cryptocurrency arbitrage and say, oh, not touching that. I'm not doing that. With good reason, because you should never do anything you don't understand. But people think that something which is unfamiliar is, you know, necessarily risky. And our kind of view is that if something is unfamiliar, it just means you need to familiarize yourself with it. And once you familiarize yourself with it, then you can judge whether or not it's risky. And sometimes it is. So you don't have to do it, right? But sometimes it isn't. You're like, okay, yeah, this actually makes perfect sense, right? And so that's kind of, you know, we kind of poke around in the kind of darker corners of financial markets to try and get kind of uncorrelated orthogonal exposures that you know, don't have any duration, really, don't have any kind of fixed income component. So we certainly don't do government bonds or anything like that. But we don't do equity, we don't do quasi equity. So we allocate to other managers, I should say, right? So we're a fund of funds, so we don't do like our own cryptocurrency arbitrage, right? We don't know how to do that, but we know people who do. We don't underwrite catastrophe risk, because that's not our thing, but we know people who do know how to do that, right? We don't fund litigation claims, because we wouldn't really know where to start, but we know people who do know how to do that. So we put all of these kind of things into a portfolio, in their appropriate kind of size, and what that does is give you something that is actually quite a kind of stable return, that's not sitting on this duration time bomb. So that's kind of how we went about solving the problem.
That's really fascinating. So you've really kind of, at least for the average investor, one of the claims I've made often is one of the more nefarious elements of today's market environment is it doesn't give people much of an opportunity to just sort of not play the game at the casino if they don't want to, because all assets are being impacted in general. At least all mainstream assets are being impacted by the trends we were just talking about. You've sort of found a way to sort of not play their game and find these alternative sort of niche investments that you can put together into a portfolio that doesn't have the duration risk that you were talking about, and I'm assuming probably has less correlation with the standard financial assets than a conventional portfolio.
Yeah, absolutely. We don't really. We don't have any correlation to basically financial markets. Having no correlation doesn't mean negative correlation. All right. So just statistically, the market can go down and your portfolio can go down at the same time, just because that's just the rub of the green. And the same way that the market can go up and we can go up at the same time. But in terms of the big episode, we're taking a lot of highly idiosyncratic risk, right? So for example, this, Hurricane Ida is something that we've been watching very closely, right? Because we have quite a big allocation to catastrophe, right? And if a Cat 5 hurricane actually went right through the center of Miami, it would hit our portfolio, right? We would take a hit on that, right? I think that over how big a hit would we take? I think maximum hit probably 20%, which would be a big hit. That would be a bad year, right? That's the kind of tails that we have, right? More likely 10 or 15 in an environment like that. But that's got nothing to do with a financial market crash, right? We don't really have that particular tail, right? And the tail that we have with our, for example, our reinsurance, is actually well contained in the portfolio, right? So it would be quite a bad year if something like that happens, a 1 in 100-year event. It would be a bad year, but it's not going to, it's not going to pull us down.
Not going to take out the fund, yeah.
It's not going to take out the fund. It can't take out the fund because it's actually very, very contained. With a cryptocurrency arbitrage, if one of the very big exchanges goes down, that could create problems, right? So we have, and I could bore you with the details, but we have a lot of idiosyncratic risk. We are taking tails, if you like. But the thing is, if you've got a 60-40 portfolio, your whole portfolio is a tail. your whole portfolio is the equity market, right? It's the equity market tail, right? And so that's what we kind of just didn't want to do. We just don't want to do. And anyway, why does anyone need us to do that for them? Because everyone's got that anyway, right? So that was our approach to thinking about the problem, really.
All right. Well, last question around portfolio allocation. You've written earlier about, I think, having a favorable opinion of gold. I think I saw one writing of yours that suggested that people might want to have as much as 25% of their portfolio in gold. Not asking you to necessarily endorse whether something, percentage that large is still the right thing to do or not, but just curious, gold sounds like the type of thing that might find its way into the current portfolio you were talking about, where it doesn't have a lot of the other concerns that you had about government and private bonds and equity markets and whatnot. So I guess short question is what's your opinion of gold right now?
Yeah, listen, we own gold. I own it privately. We don't have it in the fund, but I own gold for probably reasons you can imagine. The suggestion of a 25% allocation to gold really came out of what I wrote about, several years ago when I was at Soc Gen, and I called it the Cockroach Portfolio. And that was really just an equal allocation between real assets and nominal assets, and duration assets and zero duration assets, right? So if you've got gold, which is real, and zero duration, and you'd have cash, which is real, which is nominal, sorry, but has zero duration. And then you've got nominal bonds, another 25%, which is a nominal asset with duration. And you've got equities, which is a real asset with duration. And really, with a very, very simple allocation, you kind of, at any point in time, something will be hurting you and something will be benefiting. One part of the portfolio will be doing well, one part of the portfolio will be doing badly. On balance, it all nets out and you make a decent return, right? And the reason I call it cockroach is because cockroaches are very, 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 very successful species. I think they've been around for about 300 million years. But they're pretty dumb, right? They don't know anything, right? They don't have iPhones or edible underwear or any of that kind of stuff, right? But they survive.
Well, that edible underwear made its way into that, but yeah, go ahead.
but they don't, they're very, very, very dumb, but they survive. And so the cockroach portfolio was designed to be very, very dumb, right? It doesn't take a view on inflation or deflation, duration, non-duration. It just says, I'll just have a little bit of everything and just gather the kind of risk premium over time. And that portfolio has historically done very, very well. And so the 25% allocation to gold that's where that came from. And I think in answer to your question earlier, practically, what would you do about this? If you don't have the time to go around and find great reinsurance managers or litigation managers or correlation managers or crypto arbitrage managers, et cetera, et cetera, et cetera, you can always do a cockroach portfolio, right? Because it's designed for dummies, and it will, I think, outperform pretty much all other balanced portfolios for the cost of an annual rebalance, which is not very much, right? So I think gold has a role to play in that. I think gold has a role to play in all portfolios, because you never really know. That's why we own it. I hope that answers your question.
Well, it does, and I think it mostly answers the last question I was going to ask you here, which is just what sort of general advice would you have for the viewers of this video, most of whom I think are concerned about a lot of the issues we talked about here. I will say maybe where they differ from you a little bit is I think the average person does worry a fair amount that at some point there is going to be a reckoning here, and they don't want to be collateral damage if there is a material correction in the markets from these high valuation levels right now. I know you just made an argument that they may go a lot higher for a lot longer than people can imagine. But anyways, what would your sort of parting advice be to that type of investor who's watching right now?
I think that own less equities. Just own less, but don't own none. Don't own no equities, right? Don't own zero. Don't have a zero allocation to equities. Have something, right? Absolutely diversify the portfolio in any way you can. But I think that, you should, again, it's difficult to answer without knowing the specific circumstances of each person. But I kind of feel that equities are are probably not such a dumb place to be. You know, and if you're worried about an inflationary blow off, and I think that's equities, right? It is equities. So equities are a real asset. Don't forget, right? Their earnings go up with inflation, right? The discount rate goes up with inflation. Net, they're like, you know, if you go and study inflation protected bonds, I think you have a much better understanding and how they react to changes in interest rates and changes in inflation expectations. You get a much better understanding of what drives equity valuation. And I think that you would get much more comfortable with owning equities. If you're really worried about inflation, you know, rethink your equity exposure. Go and do the cockroach. You know, it's much easier.
Right, be the cockroach. All right. Well, Dylan, look, thank you so much for giving us so much of your time here, especially given that it's later in the day, your time there over in the UK. For folks that have enjoyed your commentary here and would like to learn more about you and follow you and your work, where can they go?
Well, you can hit me up on Twitter. I'm not very active on Twitter, but I kind of keep an eye on it. So I'm not that quick to respond, but I do respond. You can you go to the website, you know, www.cockroachcapital.com, and you can kind of have a poke around and see what we're up to. And there's kind of contact information there. If you want to reach out to me, then you know you can find your way to me from either the website or on Twitter.
Fantastic. Well, we'll put your Twitter handle and that website URL up on the screen when we edit the video here. All right, Dylan. Well, again, can't thank you enough for the time, for the wonderful discussion, and look forward to having you back on this program at some point, maybe end of the year, beginning of next year, where we can kind of track where we are in this grand experiment.
Fantastic. No, absolutely. And it's been a real pleasure. I really appreciate you having me on the show. It's very flattering and humbling. Thank you very much.
Well, thank you. It's really been a pleasure, Dylan. Thank you.
Okay, thanks, guys.
All right. Well, this is the part of the program where I bring in the lead partners of New Harbor Financial, the financial advisory firm officially endorsed by Wealthion. This week, we've got John Loder. I think Mike is off visiting a client. John, great to see you.
Good to see you again, Adam. Thanks so much for having me again.
Hey, no worries. All right. So really fascinating discussion there with Dyland Grice. Lots of really interesting concepts. He's clearly a very big thinker. I do think I'm going to predict that maybe you folks at New Harbor see through a slightly different lens than he on some of the points we talked about. Obviously, huge points of commonality in terms of what's happening, you know, role of the central banks, their impact, you know, largely negative that they're having on markets, people being forced up the risk curve in ways that probably are not going to suit them in the long run. You know, Dylan seems to think the music's going to keep playing for a lot longer than maybe most folks realize, maybe than you guys think it will last, and maybe seems a little bit more sanguine on the prospects for equities here generally than you guys do. But don't let me put words in your mouth. What's your reaction to that conversation?
Yeah, sure. So no, yeah, Dylan has a really interesting, broad-based perspective. You know, I think he shared. You know, I think his comments spoke to his history as a trader, a prop trader at different firms that he worked for, but also a little bit of philosophical, banter about government and power, and really fascinating range of comments. So I appreciate his perspectives there. Yeah, I think you know, the degree to which we do share different perspectives, and we do, quite frankly, it really gets into some really important nuances that, you know, I think maybe we didn't dive deeply enough into the conversation there. So I'd like to just maybe kind of call out a couple of those. You know, he rightly points to the relationship between interest rates and valuations. You know, really stocks being, you know, valued relative to bonds, and he rightly points out that the real egregious catalyst here is that the bond market is so horribly mispriced, and it's horribly mispriced because central banks have gone in and printed money out of thin air to buy up bonds with reckless abandon to the tune of billions of dollars, you know, many billions of dollars a month. And that's why the Federal Reserve's balance sheet has ballooned from 800 billion in 2007 to over 7 or 8 trillion. I've kind of lost count, frankly, to where we are today. So yeah, the bond market has been absolutely destroyed in terms of true price discovery. And as a result, the relative pricing of stocks have also been destroyed or distorted from what really they should be valued at. And the kind of analogy I like to use is, to say that the stock market is properly valued relative to bonds on a relative basis is to say something like, a junky, 1985 Honda Civic that's priced at $150,000 is fairly priced as compared to a similar vintage Toyota Corolla of equal condition. That's kind of the lunacy of kind of where things are. A couple things. Interest rates are an interesting. People oftentimes misuse or misunderstand how interest rates factor into valuations. This is 101. This is finance 101. If you take a future stream of earnings for like a company or the stock market and discount those to a present value based upon current interest rates, you get a present value as to what those future earning streams should be valued at today. So if you're using a very low interest rate, yeah, the value today is going to be higher than otherwise would be the case present value. But what people misconstrue is that the returns in the rearview mirror that are resulting from that distortedly higher present value, they've been stolen from into the future. To assume that those rearward-looking returns are going to continue into the future is absolutely a misunderstanding. Because to say that stocks are fairly valued today, you would also have to say that future returns on stocks are likely to be much lower than historically they have been. To not agree with that is a fundamental error in understanding how interest rates. To put it another way, if I know what the price of the stock market is today, or the price of a given stock, and I project what the earnings of the stock market or that stock are going to be over the next 10 years, which is what Wall Street analysts do all the time, and they have a horrible track record. They usually get it really wrong. Interest rates don't even factor into that equation as to what the future return will be. That's a simple internal rate of return calculation. Again, finance 101. It's independent of interest rates. The current value, the starting value, and the future, our earning stream over the next decade. I can tell you what the rate of return is going to be without knowing what the interest rate is. So there's a big misconception that low interest rates means perpetually higher returns. That's a so it really gets to the question of if you're going to be allocated to stocks modestly or heavily, to assume anything like the returns over the last decade would be a complete and utterly misguided assumption to make. Think about low to no or even negative returns, because the market has overshot, as the data will tell you, where even low interest rates suggest this market should be valued. Long-winded comments there, but that's a really key point that I think investors have to understand. And I want to make one more comment. He referred to the market. It'll be fun while it lasts, kind of reminiscent of the Chuck Prince comments in the late stages of the tech bubble, that we got to dance while the music's playing, or musical chairs. That's a cute thing to think about. It's not so cute to folks who are trying to be careful with their life's earnings, the only earnings they'll ever have, and the only retirement security that they'll ever have, to kind of flippantly kind of think about it as a game to have fun while it lasts, is really I think putting the blinders on as to the likely carnage that could and likely will occur from these lofty levels. So I'll pause there, Adam.
Okay. And just to be clear, I totally get your point there. I don't think Dylan was trying to be disrespectful of the individual investors' skin in this game there, but I agree that anything that sort of smacks of that Chuck Prince, get a dance while the music's still playing. I think one of the things that's so, again, nefarious about the current market conditions is a lot of people are out there on the dance floor dancing, but they feel like they're having to do so at gunpoint, where they'd really rather be, leaving, going home, watching Netflix, whatever. But because they have to get some return in this zero interest rate world, or rock bottom low interest rate world, they find themselves out there doing these things that feel very unnatural and make them feel very vulnerable and exposed. I do also just want to point out too, John, on this program in the past, we have trotted out lots of charts. I think you even have a few here you're about to show, but charts like the one from John Hussman, that show that if you look at the returns that we've had over the past decade, how outsized they've been, and where valuations are now, we're looking at negative returns for the next decade. I think the latest chart we showed was like negative 6% return annualized over the next 12 years, right? So I just want to mention that today's Wall Street Journal actually features an article which basically says, and I'm quoting here, investors buying stocks no matter what shouldn't fool themselves that the future will deliver the chunky returns of the past decade, which is basically making the same argument that you just made there, John. And I just wanted to highlight it to say, it's not just us in our corner of the internet. It's not just guys like John Hussman, who are still kind of, despite his brilliance, sort of pushed to the side as sort of niche. Now it is kind of beginning to creep into the mainstream, where even the cheerleaders at the Wall Street Journal are saying, whoa, hey, we got to start being realistic about this. So I'll hand it back to you, John, because I know you had some data you wanted to walk through.
Yeah, so actually one chart I want to call to attention, maybe you can flash it up here, is, and I sent you this several days. It's a chart put together by Tavi Costa from Crescat Capital. And it's basically a chart going back to the early 1900s. And it's a chart of what's called the 5-year adjusted earnings yield on the S&P 500. Now, the earnings yield is simply the inverse of price to earnings ratio. If you take the PE ratio of the S&P and invert it, it's basically taking the earnings, dividing it by the price. And folks oftentimes use this, and this is getting back to the relative valuations of stocks compared to bonds. Folks will oftentimes use this as a shorthand way to say, are stocks under or overvalued or fairly valued relative to bonds? And again, I've already talked about how the relative valuation of stocks and bonds is kind of ludicrous because of how bonds are distorted. But this chart shows that going back, so right now the 5-year cyclically adjusted earnings yield on that series is about 2.83%, 2.8%. And if you go back in this long history of data back to the early 1900s, the only other times in history where these levels were kind of approached, and a low earnings yield basically is equivalent with a very high price stock market, just like a high PE ratio is because it's the inverse of a PE ratio. The only other times in history where this earnings yield has approached where we are now is the tech bubble, the very top of the tech bubble in 2000, the 1937 stock market peak, and the 1929 stock market peak right before the Great Depression. And this chart shows you what the subsequent returns over 1, 2, 3, and 5-year period were in each of those instances. And in each case, they were profoundly negative. The average 3-year performance, for example, of those prior examples that are similar today, at least on a metric basis, was about negative 53%. Now, I'm the first to say, this is no guarantee of future, but it does put into context that, we are, just another way of saying the stock market is massively overvalued, and to expect future returns that resemble the rear-looking returns that brought us to these bubble peaks, it would be very naive and very at odds with all of history. Yeah, there's another chart here that I sent you that's quite a busy chart, Adam. It's one that John Hussman put together, and it's actually a 3-dimensional chart, so it's a little hard for folks maybe to understand if they're not conversant with these kinds of 3D charts. But the simple, if one wanted to study this chart, they can go to John Hussman's latest monthly piece at hussmanfunds.com. And basically what this chart does is it quickly disabuses the notion that low interest rates mean higher returns. This chart, very clearly shows that, when you have high valuations, which is what the S&P over the highest forward operating earnings axis represents, even if you have low interest rates, the subsequent returns have been very, very low and disappointing. Again, a busy chart. I don't expect folks to but I just want to point out that the data is there to really, from a factual standpoint, disabuse the notion that low interest rates are a license for indefinite, great returns for stock investors.
All right, and just more data for what we were talking about earlier. It seems that no matter kind of what lens you look through when you're looking at the data, it is suggesting that the party continuing in equities for another 2, 3, 4, 5 plus years here. I'm not saying that it can't happen, but it seems highly unlikely given what the preponderance of data is telling us. I also want to just put up one tweet here that I found interesting. John, feel free to comment on it, but so this tweet is from Carter Braxton Worth, and he says, for the month of August, we've made 10 new intraday all-time highs in the S&P. This hasn't happened in the months of August since 1987. The record number of intraday all-time highs in the month of August is 11, which happened in 1929. Hey, who knows what, if anything, is going to happen according to this data that might or might not be similar to 1929. But you had just mentioned in the data sets you were looking at, John, again, we're seeing similar levels of extremes that we saw at some of these key market turning points in history. Just curious, if you have any feedback on that bit of data here from Carter's tweet?
Yeah. Well, taken at face value, those are some not so welcome, comparative points in history. The 87, that was right before, and valuations in 87 were way lower than where they are now, not even close. And yet there was a stock market pullback of, I think, 22% in a single day in the crash of 87. And that was after a pretty horrific week in the stock market preceding that one day decline. So elevator drops can happen even from far lower valuations than we have today. And of course, 1929 is infamous in terms of the gateway to the Great Depression and the massive destruction of capital that happened there and took 2 decades to get back to even. One chart I share with you, Adam, I thought it was a really interesting point, a data point, because it's a chart of Dick's Sporting Goods, a company that most folks are quite familiar with. It's not a particularly sexy or novel new company. They sell sporting goods, right? And yeah, people love sporting goods. They wear out, so they're continually coming back to buy more. But take a look at this chart. This is a 20-year chart. Each one of these little bars is a month over this 20-year history. And you can see to the right-hand side, that's the latest period of time. You can see the little COVID sell-off in March of 2020. That the stock peaked in March of early 2020 at about $48 a share. Sold off down to as low as about 12 or 13. Here we are today, after a pandemic, whatever, things are opening back up. The stock is at $150 a share almost, okay? Almost 3 times where it was prior to the pandemic. Now, I get it. I get that, sports programs were put on ice and didn't happen for a year or not in the same way, but people were still working out at home, buying, sporting equipment, shoes to work at home. But, the fact that this stock has tripled and way more than that from the March low. I mean, most people at home can kind of just, sanity check this and say, there's no good reason that, society hasn't changed in any fundamental way to make this stock not only its highest price of all time, but, massively more valuable than it was right before the pandemic. This is just a simple, example. And there's dozens, if not hundreds of examples like this that make up the stock market, which is, making these highs. It's one story after another of crazy stocks driving a crazy market bubble even higher.
Yeah, I think Dylan had said in reference to something else, but it's almost sort of like a self-propagating system at this point in time. People are buying because it's going higher, right? And again, that is just the classic sort of momentum chasing that you see at the end of these bubble manias. All right, John, well, as we wrap up here, let's just talk very briefly about any thoughts that you and the team at New Harbor has about the markets. We are back again at all-time record highs in the S&P and I think most of the other indices there. I got to give credit to David Hunter, who we've had on this program a couple of times and we've been tracking. folks, whether or not you agree with his predictions that he's been making over the past year, they have really been spot on so far. And David is, right now very vocally predicting that we are in the end stage of the melt up, and he sees the S&P potentially going as high as 5,000, maybe a little bit more, which is about 10% above where it is right now. And for a lot of people, that feels pretty hard to swallow if you don't believe the rationale behind today's asset prices. But of course, the other part about David's prediction is he believes once we hit that blow off top, the market's going to have a massive sell-off, somewhere on the order of 65 to 80% decline. So, in David's mindset, we're seeing one last valiant ramp, and then the whole thing comes on down. But anyways, John, what are you guys thinking right now as you're looking at the market action over the past week?
Yeah, well, that forecast of David, that's like a perfect example of kind of the dance while the music's playing kind of temptation, right? We would be the first to admit that, sure, this market can go higher in the short term. It's just a question of where does that get us, and where does it likely, what happens from there, and what does it mean for the returns or lack thereof that clients actually get to keep, and what does that mean for their financial security, not over the next 3 months or 6 months, but over the next 20, 30, 40 years of their life, because our clients don't get a do-over typically on these things. So that's a conversation we can have with each and every one of our clients as to how and if they want to try to kind of ride any momentum further that might be in store for this market. But it's a very tricky one that we at least want to inform our clients with data. And at the end of the day, it's really easy to increase allocations to stocks. It's just a matter we want to be open-eyed, both for us and for our clients. And I know my personal money is invested just like most of our clients, and we think it's very careful times are really important. But yeah, the fact that markets are making fresh all-time highs is it is what it is. It doesn't really change, I think, anything in terms of where we likely are in the cycle. It just makes it that much more emotionally and psychologically torturous, frankly, for folks that are trying to be cautious and trying to be careful with their money. And that spoke, Dylan spoke very, very, very vocally about that. This is a torturous situation for folks. They and Adam, you made the point as well. They feel like they need the return, so they're being tempted into something that has gone up, but won't continue to go up, or at least won't continue to go up without then a massive give back on the other side. So now it's time really to just be really open-eyed about realities of data and cycles, and we're here to do that for our clients and folks that might be looking to explore a conversation with us that are not currently clients. We're happy to have those conversations. That's what we do, and happy to kind of talk about the risks and rewards. And we have tools, hedging tools, that we can bring to the table for those clients that want to kind of step a bit more into the risk category, but also want to be protected if that move is ill-timed.
Great. Yeah, I keep trying to think of a different analogy to use than picking up nickels in front of the steamroller, which I know is the risk that you're referring to there, John, where there may still be some momentum gains to be created. But if the risk is that, there could be a massive market correction here, you don't want to be caught unawares. And I don't know, the current one I'm toying with is if you're at the ski mountain and it's snowing fresh powder, but the avalanche risk is high, do you want to try to squeeze in the last couple good runs on that powder and risk getting buried by the avalanche? Or do you maybe just want to say, it's time to start the après ski. Let me just go in the lodge, get some hot chocolate, sit by the fire. And I think for the vast majority of people, it probably makes the most sense. We hope you've enjoyed this important discussion, folks. Before we end here, I've got 2 offers you may find of interest. The first one is a bonus video clip of Dylan and me discussing what a system without central banks would look like. It's a fascinating exploration. It's just one I didn't have enough time to squeeze into this video that you're watching now. If you'd like to watch that clip right now for free, just go to wealthion.com/Grice. And the second offer is for our newer viewers. If you'd appreciate the advice of a professional financial advisor who appreciates the risks and opportunities discussed in this video, John, his partner Mike, and their team at New Harbor Financial offer free, no commitment, no strings attached consultations. They do this as a public service to help as many people position themselves prudently today for what lies ahead. If you're interested in scheduling one of those free consultations, we tell you how at the end of this video, which is coming up in about 20 seconds. So as we wrap up here, please take just a moment to like this video and then subscribe to this channel. And don't forget to watch the bonus clip with Dylan at wealthion.com/Grice. Thanks for watching. If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.